spoke of a lot of the stocks in the flagship fund as having a longer runway than maybe some would suggest the pandemic would say. It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I've found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term. I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
Steve Weiss has a question for you, Cathie.
Hi, Steve.
Hey, Cathie, good to see you again. So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast, or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it, actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names which are creating losses now because, again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to, because they've lost a lot of their pipelines or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point in the coronavirus last year, it was as low as 33, I believe.
Cathie, Bob's going to wrap it up with you. I have one quick question. What do you view of the SPACs right now? Would you ever invest in these SPACs?
We are investing in them.
Which ones?
Not all of them. We think there's, DraftKings, Skills, Butterfly, that merger was just consummated today. Blade, which I think is still going under the name Experience, so that acquisition has not been consummated yet. So yes, we're being very careful. We don't like the opacity in some of these SPACs, and nor the incentive system in some of them. But this is a way for venture capital to have liquidity events sooner than might otherwise have been the case, giving the public markets an opportunity to invest in some innovation-oriented names much sooner than might have been the case with just the IPO process. We understand the questionable nature of the compensation schemes in some of them, though.
Interesting.